Okay, so far what we have discussed mainly is equity security, how to account for equity security, investment in equity securities. Okay, it is not the case where I am issuing equities, I am buying the equities, I am investing in equity securities, and we have to account for it using fair value to P&L. Okay, generally the case. Now we will look at debt securities. Okay, amortization video. Have you gone through? Yes. So what did you understand in amortization? What I said does not matter. What did you understand? That only matters. So you need to change from. So when you say what you said is you are evaluating me, you don't have to evaluate me. You will not get anything by evaluating. You have to see whether you have to whether you are understanding or not. That is more important. Hmm. Hmm.
At the same time, total value is same, but we are but amortization we are using both the that is similar to decision we are starting.
Okay. Is that correct? Did you go through the video? Did you understand? Okay. What did you not understand? Did you go through TVM? Time value of money? Sridhar took class. Okay, you did not attend TVM class. Okay, no problem. So what was the flow in that? Hmm. Hmm. Do you have any loans? You have. Okay. You are paying EMI. You know how it is calculated. Ah. Hmm. So your EMIs are correct. Did you check? You are paying loans, right? I mean, you are paying EMIs, right? Did you check whether your EMIs are correct or not? Whether the bank is charging the right EMI? Did you check after watching the video? Did you check? Do you know how to calculate the EMI? Not really. You are only paying no, and then you don't want to check. The numbers. No. In the table, what all you are seeing? Then headers. What are the headers? Just try to recollect it. Headers. Your EMI, you should know. Payment is the EMI amount is also there. EMI amount, principal, interest, the EMI amount, and then finally the closing balance. So whatever EMI you are paying, one part of that goes towards principal, one part of that goes towards interest. That is also one kind of amortization table, amortization schedule. That is also one part of amortization accounting only. There it is not about accounting, but amortization accounting also follows the same concept. Okay, so I will briefly again summarize the amortization principle. Okay, so what we are doing is basically we are trying to amortize, okay, basically spread over the interest income or interest expense over the period and not go by the payment. Okay, not go by the payment. Whatever is the payment, that payment will be done irrespective of how you account. Okay, accounting standards will not impact your cash flow. I think I've told this before also. Accounting standards or accounting methodologies will not impact the cash flow. Whatever cash flow from the business has to happen will happen. Okay, accounting standards only tell about how to account for those transactions. That's all. Accounting standards will impact P&L. Accounting standards will impact balance sheet, but not cash flow statement, not cash flow. Okay, so whatever you are paying is not necessarily the interest expense or income. Whether it is an investment, let's say in a bond I am doing, whatever you are paying is not interest expense. You are calculating interest expense is calculated as a percentage on the what? Outstanding amount. Right? And this interest is charged, this is charged to P&L or income statement over the period, not the payment. Right? So if your interest expense, which is calculated over here like that, is 80 and what you are paying is 100, right? Interest expense is calculated as 80, but what you are paying is 100. Next month what you are paying is 100. Next month what you are paying is 100. But interest expense will come down as you keep repaying, right? So this will become 70, this will become 60, let's say. So then what happens? This is your interest expense which you are calculating, and this is your cash flow. In the absence of accounting standard, you will take this money to the P&L. Correct? But when you have IFRS 9 or when you are having the accounting standard, you will take this to the P&L. You will not take the entire of this to the P&L. Why? Because part of this is towards principal. So how much of this 100 is towards principal? Huh? How much of this is towards the principal? Why? What you are paid is 100. That 100 is adjusted against first interest 80. Then balance is going towards principal. So in this case, how much is the principal adjustment? 40. That means from your principal, 40 will get reduced. Getting it generally in a loan where you are paying interest, right, or the cash flow. What will happen is the principal outstanding will come down. Okay, so instead of charging my P&L like this, 100, 100, 100, I will charge my P&L like this. Why? Because every year when you are paying, your loan outstanding is reducing, right? So when my loan outstanding is reducing, my interest charged or recognized in the P&L should also reduce. That is the meaning. Whatever interest I am charging or whatever interest I am recognizing the P&L, that should also reduce. Why? Because my loan outstanding is also reduced. So in a way, whatever interest I am recognizing in the P&L is accurately recognized based on the amount outstanding. Because what will happen is, if you recognize like this, your principal outstanding is coming down only, but you are overcharging your P&L in terms of interest, which is not the case. Able to understand? So that is why amortization accounting, very simply, like it follows how much is the outstanding, exact outstanding, and accordingly you recognize the interest expense or income in the P&L. Okay, and when we follow amortization accounting, let's say this is a bond, I do not look at fair value. I do not look at the fair value of the bond. When we follow amortization accounting, amortization accounting is only for debt securities, not for equity. You cannot have it for equity securities. Okay, we are talking about debt securities only, loans and receivables, bond investments, right? Either payable or receivable, only the direction will change. If you are issuing a bond, then same thing will apply, the direction will change. And if you have invested in a bond, same thing applies, direction will be opposite. Concept is same. So when I am when I am following amortization accounting, I'm not following fair value accounting. Are you getting my point? So I will not check for the fair value of the bond when I'm following amortization accounting. Correct? So now tell me, what is the implication? What is the difference based on the implication of following amortization accounting and following fair value accounting? What is the implication? I follow fair value accounting and I follow amortization accounting. What is the implication? What is the difference? Interest will okay. Then yes, what is the difference if I follow FVPL or if I follow amortization accounting? Ah. Hmm. Hmm. What is the implication? What is the effect on the financial statements of following this method or that method? Okay, then so hmm. 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 Interest will be where is the question of overcharging or undercharging? What is the implication in my financial statements if I follow fair value accounting and if I follow amortization accounting? Hmm. Hmm. So so correct. So hmm? When amortization accounting. Why? Hmm. But that is the method of FVPL, right? Hmm. How? Very good. This is the implication. If I follow fair value accounting, I have to do mark to market every reporting period, right? Whatever is the gain or loss, I have to take it to the P&L, right? So my P&L in one quarter will go up, another quarter it will come down, again go up, again come down. If I follow fair value through P&L accounting, right? There will be fluctuation in the P&L, there will be volatility in the P&L. But if I follow amortization accounting, there will not be any fluctuation, right? Because I'm not marking it to market. Are we getting it? So in one case, if I do not follow amortization accounting and I'm following fair value accounting, right? My P&L will be jumping. My performance outcome will be shown as too very volatile. Whereas if I follow amortization accounting, my performance will be shown subject to this only condition. It will be shown very smooth or trendier. There is a trend that you will see, but here there will not be any trend. The trend itself is fully volatile. This is the implication. Are we able to understand that? Because in fair value P&L, you have to understand that you are marking it to market. The price, for example, in this case, the numbers which we saw. Here you see how the price can fluctuate. Price can go up to 60, price can go up to 40, price can go up to 70, price can go up to 45, any which ways, right? It can go up and come down. That is fair value accounting. In amortization accounting, you are not even looking at the fair value. Able to understand? So now what happens is this concept, okay, or maybe we'll work out certain example, and then we will say mortgage cost. FVOCI and FVPL. These are three methods. Okay, wherein OCI means you take it to reserves, other comprehensive income. You do not bring it to P&L. Okay, and here you are revaluing it and bringing it to the P&L, and here you are not revaluing it. Okay, now let us work out this question. Quickly read this. Okay, a 9% bond. Okay, so what they're telling, I've invested in so much, and after 3 months, interest rates have come down. Okay, so and the value of the bond has gone up to 51 million. Okay, so now I will give you some time. 3 methods. Okay, either I follow amortized cost, or I follow FVOC, or I follow FVPL. Right? You will tell me how do we go about accounting for this. Are you getting it? Work it out, take some time, and then you can let me know. So, income statement. How much is the interest income in 3 months? Okay, 1.125 million. That is the interest income we are talking about. Okay, how did you get 1125? 50 million into 3 by 12. 50 million into 3 by 12. You got 1125. What did you get? What is 50 million here? Interest is how? 50 million into 9% into 3 by 12. Okay. So even if you are following fair value P&L, we'll still do the same calculation. Okay. This is the interest income you will recognize. Interest income you will recognize or interest expense. Here it is investment. So interest income you will recognize so much. Okay, in the income statement, and you will get this as cash also. In your balance sheet also you will get this as cash. Right, you will receive this money. Okay, now this you cannot equate it with EMI option. We're not talking about EMI concept here, right? Only interest is being repaid and your effective rate is 9% and the bond coupon rate is also 9%. Okay, so cash has come and P&L has been recognized in all the cases. Okay, when I'm following amortized cost or when I'm following any of the methods, interest income or interest expense you will recognize based on the amortized method or whatever income you are receiving. Okay, then this impact of 51 million, how will we show? How will we show this 51 million impact?
Yes.
So when I am investing, when I have invested in my balance sheet, what will I show? Investment value when I am investing in my balance sheet, I will show what? 50 million, right? When I am investing on the date of investment, I will show 50 million in each of the case, and cash will come down, right? Okay. Now on the reporting date, let's say after 3 months, what will be the value I will have in the balance sheet? Where? So this 1125 income came and cash came, debit and credit. 2 legs. In the P&L I have shown the impact and 1 leg I have shown in the balance sheet. Clear? Okay. Now investment value was at 50 million. Now the value has become 51 million. So this effect where will you show and how you will show? Where? OCI. Okay, you will show what? So basically this is that's liabilities. Okay. So investment value will go up. Unrealized gain or loss. Okay, how much? 1 million. Where? Column number? Column number 2. G. 1 million. Here. Okay, so first 1 million I put, other leg OCI. OCI will be 1 million. Okay, and one more leg will be there, no? Retained earnings. How much? 1, 2, 5, 10. Here, same. Here also, same. Understood? Right? This value has gone up. So I'm in OC, I'm showing. Okay, so if I look at my, let's say initially I had a capital in my business of 50 million. Correct? That 50 million only I am investing. Right? Capital 50 million, invested 50 million. Okay. So now you see whether the assets and liabilities are tallying or not. Where ma? Here. I'll come to that. Okay. So unrealized gain or loss, and you have increased the OCI by 1 million. Now third case, unrealized gain or loss, million. Then this will also go up. Correct? 50 will become 51. This loss will come to, gain will come to retained earnings. So this will become how much? So total is, okay. See if you are able to understand this. Look at what is happening to income statement. Look at what is happening to the balance sheet. These are the totals. Total assets, total liabilities. See if you are able to understand how choice of accounting policy can impact the balance sheet and the financial statements. Tell me what is the difference in each of this. So here your P&L is fluctuating. So tomorrow this 51 becomes 50.5. You will record a loss of 500,000. Right? You will not do anything in these two cases. But in the balance sheet, you will record this loss. Okay. You will bring down the value of the investment. What will happen is every time there is a change in value, you have to reflect it, you have to market to market. Right? So that volatility, which is said, that volatility can be seen in the P&L, okay, in the fair value accounting. So your P&L here is 2.1 million. In both these cases, it is only 1 million each. Able to understand? Right? So now tell me, a management which wants to give a smoothening outcome will prefer what? Amortized cost or fair value? Amortized cost. Right? So what will happen? Given a choice, everyone will go for amortized cost. They will unnecessarily not want to show the volatility in the performance. They will not want to show the volatility in the performance. So now what will happen is, but these are different methods of accounting which IFRS is giving you out. Right? Now, do I have a choice in using any of the methods? Based on the scenario itself, do I have a choice to use amortized cost or FVOCI or FVPL? Why? For debt, so for debt we are using FVPL here, no? Ah. Ah. But given a choice, what you will say? Yes, I want to hold it till maturity, and you will sell it after 3 years. Then, so you are telling my intention is to hold till maturity, and I will sell after 3 years, after 2 years, after 6 months. Then I say I will follow amortized accounting. I will not reflect market values because market values are fluctuating a lot. So I do not want to take that risk of reporting a volatile P&L. Then what will I do? Which is a preferred method for me. Amortized cost is what I will want to prefer because again volatility point. Okay, so what will happen because people will prefer, right? IFRS says no, I cannot give the preference or choice. There are certain conditions as to when you can use amortized cost and when you cannot use it. Okay, so it goes in length. I will try to explain it in a little summarized way. So what happens now? We understood that amortized cost gives a very smooth P&L reporting, unlike fair value, which can fluctuate your P&L, can send out different messages to the investors or the stakeholders, right? So amortized cost method is preferred. However, what IFRS says, it lays down certain conditions as to when you can use amortized cost. What was happening? Okay, as to why this IFRS 9 brought in this amortized cost, what was the reason? Many financial institutions, okay, mainly banks and other financial institutions, right, whose main purpose is to give out loans. Okay, now in India for banks, IFRS is still not yet applicable. Okay, now what happens? What is happening? Banks and other financial institutions, they are giving loans, correct, to various businesses. And this method is, we are talking about financial assets, financial instruments. Financial instruments are what? Financial asset and financial liabilities. What is a financial asset? What is a financial asset? Meaning we discussed. Financial asset, meaning. Just potential to go upward. That is non-current assets, property, plant and equipment. Financial asset meaning financial instruments, financial asset and financial liability. What is a financial asset? Discussed last week, we discussed. What is this? Financial asset or financial liability is what? Cash, security which gives right to receive money, security which gives ownership, equity investments, loans, bonds, security which gives ownership. So this will be equities generally. Okay, security contract which comes with potentially favorable outcome. What? Derivatives. Okay, and convertible securities will also come here. Convertible bonds, debentures, okay, convertible preference shares and all. So financial asset is what? Basically, loans and receivables, sundry debtors, they're all financial assets. Okay. So what is happening? Banks are giving loans, right? Primary objective of banks is giving loans. So what happened? Banks also want to make money. Loans, if you give out, means traditional interest rate. So then different clients started approaching in a different way, telling that, okay, I want traditional assets are not there. Earlier, you had plant and machinery, land and building. You gave that to the bank, and bank would hypothecate and give you the money. Or if you want to buy land and machinery, land and building, plant and machinery, bank will fund that purchase. But you do not want to do that. You want to do different things, right? So bank said, okay, you want to do this, you need funds for this. Okay, I will give, but I also want a profit share. I'll give you loan. I want profit share. Different types of loans. Okay. Call it as transaction banking also. Different various jargons are there. Okay. So for example, let's say you want loan to buy inventory. I will buy inventory and give it to you. You want loan to set up the business. I will set up the business and give it to you. You want loan to set up an office in overseas. I will set up and give it to you. Right? But in return, I need profit share. So this business is also telling, okay, you know what is happening? Is it a nature of loan or is it in the nature of investment? It is investment. So what IFRS said, what accounting standard says, what regulator says, you are a bank, you are supposed to give loans, but what you want to do is not my business. My business is to tell how you have to account. Right? So what regulator came up and said, you want to do this, but this is not in the nature of loan. This is in the nature of investment. You cannot follow amortization accounting to follow fair value accounting. Right? So then they asked, okay, what is this? Why should we follow fair value accounting? Why not amortization accounting? Then they said, you can follow amortization accounting only if whatever cash flows you are expecting, okay, they should be, what are the contractual cash flows should be in the nature of principal and interest. Whatever cash flows you will get out of this investment should be in the nature of what? Principal repayment and interest repayment, not in the nature of anything else. So this is something called as SPPI test, solely payments of principal and interest. Okay, this test every bank goes through. Every transaction is subjected to this test, where you sit and identify whether whatever contractual cash flows you have mentioned in the agreement, are they in the nature of principal and interest. If they are in the nature of principal interest, then you can follow amortization accounting. But if they are not solely in the nature of principal and interest, then you cannot follow amortization accounting. You have to go for fair value P&L, fair value OCI. It is more like an equity investment, something like that you can say. It is giving you a right of profit share, not in the nature of principal and interest. That means that business can go bad also, right? Right? If you're asking for profit share, then you will have to have a share in the loss also, irrespective of the nature of the agreement. You can say that I will give you loan for this, you have to pay me interest 9% plus profit share. Still, it is not in the nature of principal and interest, because you are getting profit share and you are getting interest and you are also getting profit share. That cash flow, those contractual cash flows are not fully in the nature of principal and interest. You cannot follow amortized accounting, follow FVPL. So what happens if I follow FVPL? I have to look at the fair value and mark it to market, right? Identify the value, and any differential I will have to take it to P&L. Okay, this is called as basically business model test. Okay, nature of the business, whether your business model is complying with SPPI. If it is complying, means amortization accounting, otherwise no amortization accounting. Able to understand why accounting standards are telling like this, so that if you have invested as a financial institution, no one is stopping you from doing so. No one is telling you cannot. Being a bank, how can you do? That is your bank's problem. That is the management's decision. Accounting standard cannot tell how you can do the business. Accounting standard can only tell how you can record the transaction. That's all. Accounting standard is not here to tell that you should not do this business or you should not do that business. My role is only to tell how to go about accounting for this. That only I can say. Nothing more, nothing less. Okay. So business model, if you comply with, then if you comply with this test, then you can follow amortization. Otherwise, so what happens? Effectively, you are making sure that the management, right, is not hiding anything. Right? If they have invested in certain projects in the nature of equity or in the nature of profit share, then you have to follow FVPL or FVOCI. So what will happen in that case? You have to remeasure. Once you remeasure, what will happen? You will take the hit to the P&L. Able to understand this? Okay. Now, do you need all this information for your exam? No. Why I am telling is you don't have so much as far as your scope is concerned in the syllabus. I thought I will share more as a knowledge purpose. The implication, because this accounting of financial instruments has a huge implication across all the industries. Whether you are a financial institution or not, whether you are a regular manufacturer, whether you are a regular retailer, you will have investments which are in the financial securities, financial assets and financial liabilities. And you will always have financial liabilities, irrespective of who you are. You will always have financial liabilities. You will, most of the businesses will take loans. Most of the businesses issue bonds and debentures, right? So debt they will definitely have. So for them, they have to account it on financial liabilities. Generally, you will account using amortized cost only. Financial assets is where the question mark or the debate or the argument comes, which also is now clarified by IFRS 9 comprehensively. It says follow this test. If you meet this test, then amortized accounting. Otherwise, come and show the difference in the P&L or OCI as the case may be. Able to understand this? Right? So as I said, this has implication across the industry, right? Every industry has implication, and more so financial institutions. Okay, more so financial institutions, NBFCs, okay, banks, right, fund houses, all of this have a huge implication on account of this. Now, if you are talking about a derivative, future forward options, everything will come in column I. Only FVPL. Okay, no FVOCI, no amortized cost. In certain cases, FVOCI, but generally FVPL. If you're talking about derivatives, if you are having a position in derivative, forward contract, futures, options, swaps, option, PCP, anything you talk about it, it will go to FVPL. That means you have to mark it to market on a daily basis. Yes, you have seen those who have attended derivatives class, your futures contract, the options contract, where you have margin to roll it to market, then you have to account for it. Clear? Derivatives means FVPL only. Equity means no amortized cost, either one of these two only. There is a question of amortization. For amortization, you need to have a maturity. For equity, there is no said maturity. Clear? Able to understand? So, here we are discussing about accounting. In your equity, you will, when you are learning equity, you will see how the value changes. When you are talking about derivatives, you will see how the value changes, right? If I'm entering into a derivative contract today, how much will I record in the balance sheet today? Derivatives, who all have attended? I'm entering into a derivative contract today, forwards. How much will I record in the balance sheet? Zero. Initial value of derivative is what? 0. Right? And once you start doing mark to market, whatever gain or loss that comes, that you will show here in the FVPL and in the balance sheet also, to the extent of your gain which you have made or to the extent of loss which you have incurred. Clear? So this is your financial instruments Okay, the scope is limited as far as your syllabus is concerned. Obviously, you will have this all. This classification you will have. Okay, now read through this. There are certain. I think this you have. I showed you last week, right? Okay, now read through this quickly. So you see now, basically, they're telling fair value through P&L same for both IFRS and GAAP. Default classification in IFRS is fair value through P&L unless you elect amortized cost. When you meet the SPPI test, when you meet the business model test, then you can follow amortized cost. Otherwise, by default, fair value for all the securities, equity and debt. US GAAP, fair value through P&L, default for trading securities. Okay, for trading securities, that means those securities, okay, which you are not going to trade, that may not be a default classification. Okay, then amortized cash, amortized cost, basically same SPPI test. Okay, in IFRS, in GAAP, applies to all the head to maturity debt securities. That means what? Under US GAAP, you don't follow this test. Okay, if it is a debt security, you apply which accounting? Amortized. Are you getting it? Initially, the intention is important. What was your intention? What was your business policy to invest in the securities? Is your intention to hold it till maturity? Then, okay. And this securities cash flows are in the nature of principal and interest. Then you follow amortized accounting. Is your intention to trade, right? Be it your debt securities or be it your equity securities, then you will show it as held for trading or FVPL. What is your intention at the beginning? That is what matters, right? So let's say my intention is to hold certain security for 4-5 years, okay, and then I am selling it after 6 months. So anything wrong in that? Right? So my intention is to. So if I'm talking about SPPI compliant securities, debt security, where interest and cash I'm getting, where interest and principal I'm getting, and I'm showing it as amortized cost. Okay. But my intention is to sell in the short term. Then, are you getting my point? It's a loans and receivables or it's a bond, SPPI test. Okay. But my intention is not to keep it till maturity. My intention is to sell in 5-6 years or before the maturity. Then, will I follow amortized accounting? Will not follow amortized accounting. Will follow FVOCI. If it is a bond, right, which is giving only your principal and interest, you are trading on a daily basis. Then what you will follow? FVPL. Okay. Now my intention is to not to trade. My intention is to keep till maturity only principal and interest. SPPI. I'm showing it as amortized accounting. I'm not following fair value P&L. Getting it? It's a bond. Will hold till maturity. Whatever I'm getting is principal and interest. It is not in the nature of profit share. Right? I'm holding it till I will hold it till maturity. That is the intention today. After 6 months, prices came down drastically. And if I continue to hold, prices will fall further. So I'm selling it. So is my choice of amortized accounting correct or incorrect? Able to understand? When I purchase, what did I say? I will do like this. But after some time, I'm doing like this. Is that correct or not correct? How correct? I told I will hold until maturity. Then, so every time you say due to circumstances, you will register for the CFA exam, and then you will say circumstances at my home are not good, so I will not come and take the exam. And that happened. But no, today my intention is to hold till maturity. Can this situation come? The situation can come. So that is why they are telling intention. Now, tomorrow, if something drastically goes wrong with that other company where you have invested, you will not hold on to the security, right? You will have to sell it. So nothing wrong in that. But that should not become an habit. Are you getting it? That should not become a habit. So now what is next? What is reclassification? Reclassification is you can change from one policy to another policy. For example, today I am telling my intention is to hold it till maturity. But after 6 months or after 1 year, no, we are reviewing it and then we are telling no, not till maturity, only for a few years. Then I can reclassify from amortized cost to FVPL or FVPL to amortized cost. Okay, that is reclassification. No reclassification is permitted under US GAAP. You will not be tested in detail on this, but just try to understand the principle at a high level. Reclassification, because this entire standard is about what? Measurement as well as classification. Right? How you classify, based on that you measure. Right? If I am classifying it as amortized security, then amortized method of accounting. If I am following FV, if I'm going to sell it in the short term, FVOCI. Trading means FVPL. Your classification determines the measurement here. So that is why they are giving provision for reclassification also. Equity investment, I can go through FVOCI, FVPL in the IFRS, in GAAP, mandatorily PNL only. Okay. Now, there are, so as I said, last week we discussed, so I told Tata Motors 1 share, 2 shares, 100 shares, and 1 crore share. So, what did we say? If you are talking about controlling stake, then the accounting process is different. We follow something called as consolidation, business combination. Where I am holding 50% or more stake. Where I am holding 20% or more stake, again equity method of accounting, different accounting. There you will not follow FVPL. Even though it is equity investment, there you will not follow FVPL. Here we are talking only about small stakes, which are non-controlling stakes, which are not having any influence stakes in another company. How do you account for them? If you are having stake, if you are having equity investment, which is reasonably bigger stake, then the way we account is different, which we will see in level 2. Not now. Here we are discussing only mainly about smaller stake through equity investments in different companies. Okay. So these points you may have to remember. I will give this notes also. This is more for your understanding the implication. There is a lot more in IFRS 9. I need at least 10 hours to complete entire IFRS 9. We have a lot of things. Provisional loss is there, right? Revocation method is there. Irrecoverable method is there. A lot of things are there. But from your scopes perspective, syllabus scope perspective, this is more than enough. Try to understand why I am doing this. Tomorrow, from a job perspective, you should, tomorrow, if there is something comes up, you should be able to refer to it and refresh the concepts. Right? IFRS 9 is a given question in most of the interviews. Clear? Any doubts? Did we understand? Okay. So very simple. We are talking about financial assets, financial liabilities, financial assets, all types of securities, you can say, loans and receivables, right? How do we account now? If it is a loans and receivables, sundry debtors, means that how will I account for it? Sundry debtors. Sundry debtors, how will I account for it? FVPL, FVOCI, or amortized cost? Amortized cost only. Right? Sundry debtors, amortized cost only. There is nothing to amortize. You will receive within 3 months, 6 months, whatever it is. And if it is going to delay, you are going to charge interest. Right? It is in the nature of principal and interest only, even if at all if you are charging interest. So sundry debtors I have to follow what amortized accounting. There is nothing like amortization though. It's a straightforward thing. Bond investment, either amortization or FVPL or FVOCI, equity investment only fair value accounting. Derivatives only fair value accounting. Okay, if I am trading in derivatives, I have to account for derivatives. It will be through fair value only. not not fair value through P&L only, not OCI also, not amortized accounting also. Okay, by derivatives you are able to measure mark to market. You have seen it in futures, you have seen it in options, right? Mark to market. Clear? So this is about your balance sheet financial instruments. Clear? Any doubts? Okay, so we'll take a break and then